Welcome to The Explainer. Today, we're looking at a puzzle. We've got a new company about to go public, and on paper it looks pretty great. But for some reason, the market is giving it the cold shoulder. Let's try and figure out why.
You know how it is with initial public offerings or IPOs, right? They always feel like this golden ticket. They're pitched as this amazing chance to get in on the ground floor of the next big thing, to invest in a company's future growth right from the start.
But let's be real. It's rarely that simple, is it? Especially when the market is feeling a bit nervous. How do you tell a genuine opportunity from a risky bet that could totally backfire? So, here's what we're going to do today. We're going to use the upcoming IPO of Omnitech Engineering as our case study. By really digging into this one company, we can build a kind of framework for how to think about any new public offering you might come across.
Okay, let's get into it. First, we're going to build what's called the bull case. That's all the good stuff, all the reasons why this company looks like a really attractive investment.
Right off the bat, Omnitech seems to have a very solid foundation. The people running the show are experienced, they really know their stuff, and they operate in a very specific, high-precision engineering sector, which basically means it's really hard for competitors to just jump in. On top of all that, their order book is huge, and analysts seem to agree that its price tag is actually pretty reasonable compared to its competition.
And here's the number that'll make you sit up. An average revenue growth of 39% over the last 3 years. I mean, wow, that is impressive by any standard, and it's a powerful signal that the business is expanding, and fast.
And not only that, they have a massive global footprint. Almost 80% of their revenue comes from exports. That means they aren't just dependent on one single market. That kind of international reach is a major strength. But, every investment story has two sides. So now, let's flip the coin and build a bear case by looking at some of the hidden risks that aren't so obvious when you just scratch the surface.
This highlights a really crucial disconnect. Remember that awesome 39% revenue growth we just talked about? Well, their profit growth is only at 16%. That gap suggests that while they're definitely selling more, their costs are rising, and they aren't actually becoming more profitable at the same speed. That's a bit of a red flag.
And here's another pretty significant risk. A massive 70% of their entire revenue comes from just 10 clients. Think about that. That's a huge concentration risk. If they were to lose even one of those big customers, it could have a really serious impact on their bottom line. And the financial headwinds keep coming. The company is carrying a lot of debt. It also takes them a very long time, over 8 months, to actually get paid for the work they do. That puts a huge strain on their cash flow. And maybe most telling, a key measure of how efficiently they make profits has been cut by more than half.
So here's the crucial point. We've pretty much established that Omnitech is a decent business, if a little complex. But a good company doesn't always make for a good IPO. Those are two very different things. So what is the market saying about this public offering right now?
Before we get to the numbers, it's really important to understand this one term, GMP, or gray market premium. Just think of it as the hype meter. It's an unofficial indicator of how much excitement and demand there is for an IPO before it even lists.
And Omnitech's GMP? A tiny 1%. This tells you there is almost zero demand for the shares in the unofficial market. Investors are absolutely not expecting this stock to pop or deliver any quick gains on its listing day. The buzz just isn't there. This complete lack of enthusiasm is confirmed when we look at the official numbers. Both the big institutional buyers and everyday retail investors, they've failed to fully subscribe to their shares. The only group that really showed interest was the company's own employees.
And it's so important to realize, this isn't just about Omnitech. The whole IPO market has turned pretty cold. Many recent IPOs have performed poorly, which really suggests that the era of easy listing day profits, it might be over, at least for now.
So let's put all these pieces together. We have a decent company that has some very real risks, and it's trying to launch in a really skeptical market. What does this actually mean for you, a potential investor?
For anyone looking to make a quick buck from the listing, the data strongly suggests you should probably avoid this IPO. The demand just is not there. For long-term investors, though, the story's a bit different. The company itself is fundamentally decent, so the smart play might be to just hang back, watch how it performs after listing, and you could potentially buy the shares at a much better price once all the initial noise settles down.
And this all brings us to a final, much bigger question. With markets no longer rewarding every single new company that goes public, are we entering a whole new era?
an era where investors have to ignore the short-term hype and focus only on a company's true long-term value from day one? It's definitely something to think about.